My name is Tom Moran. I'm the managing and founding partner of the Moran Edwards Asset Management Group of Wells Fargo Advisors, located in Naples, Florida. The U.S. economic expansion is on a substantial, though slow, growth pattern. The slow pace of the recovery likely means that the economic expansion will last longer than it might have otherwise. The economic recovery could keep growing through 2020, making it the longest post-World War II expansion in U.S. history. Expansions usually end when excesses result in government intervention to deliberately cause the economy to slow. This seems a long way off. While stocks are no longer cheap, they remain attractive relative to the expected returns on cash and fixed income. So, dividend paying stocks make a sense for investors who seek a balance of income and growth. Over a 10-year time frame, a portfolio of high-quality dividend-paying growth stocks will likely outperform both cash and corporate bonds on a total return basis. Dividend growth can provide income and an inflation hedge. It can also potentially dampen volatility. The S&P 500 dividend-paying stocks are much less volatile than the market in general, and dividends have grown at a rate of 5.6% since 1926. When yields are below 5%, rising rates are generally associated with rising stock prices. Investors should stay fully invested and buy market pullbacks while the economic recovery continues. Also, stay diversified. Diversification partially mitigates a portfolio's long-term volatility while retaining the potential to gain from positive returns. Even these prospective improvements, low oil prices and commodity prices should help keep U.S. and global inflation in check and below average levels. Overseas, monetary stimulus should support improved global confidence as long as there are no shocks to the United States economy, which is still recovering from the 2008 crisis. Keep in mind that aggressive monetary policies from foreign central banks will keep foreign yields depressed in many countries. While the prospect of rising interest rates worries many investors, there's no reason to be concerned. The history of the last two tightening cycles shows fundamental growth resulting in expansion of the S&P 500 index for multiple years past the start of the first rate increase.